Hi, I'm Brenton Garen with ETF Trends and ETF Database, and today I'm joined by Chris Huemmer, Senior Investment Strategist at FlexShares. Chris, infrastructure has been in the news a lot recently with the US House passing a $1.5 trillion spending bill last week. What is your take on recent developments?
Thanks, Brenton. Thanks for having me. The House bill you're referring to is unfortunately unlikely to succeed. It was passed right before the 4th of July holiday. The Senate chose not to vote on it before the break, and there's been some opposition in the Senate to it. That said, we always see bipartisan support for infrastructure spending, simply because it's a way to generate jobs growth. With that in mind, though, when I talk to investors, I'm often emphasizing that they do not wait on a resolution from Congress and look to invest in infrastructure through the public markets, because they're often surprised at the amount of infrastructure assets that are available to invest in. Some of the largest airports, whether you're talking about Charles de Gaulle in Paris, the largest airports in Frankfurt, Germany, and Sydney, Australia, they're all public securities. Some of the largest seaports across the globe, or even here in the US, things like cellular towers and data centers, those are all infrastructure assets that we can invest in through public markets.
How is investing in infrastructure beneficial for investors?
Brenton, I've been talking a lot to both financial advisors and institutional clients about infrastructure as an attractive asset class. For several reasons. One, portfolio diversification. Infrastructure and real assets in general have a lower correlation to equity markets as well as fixed income markets. So there is a potential benefit for investors to add it in addition to their typical 60-40 portfolio. Additionally, because infrastructure assets tend to be these mission critical services that are needed by everyday individuals, whether we're in a booming economy or struggling a little bit like we are today, everybody needs access to water, waste management, particularly in the stay-at-home environment, being able to access information via the internet. Because of this, their infrastructure assets tend to be defensively positioned and do well when we have increases in volatility, as well as when there is downward pressure on markets. So because of that, tactically, it's been looked at as a positive today. And then finally, within the low rate environment, infrastructure is a source of dependable income. If you think about infrastructure assets, they tend to have very predictable cash flows because of the mission critical nature of the services, but they also have fairly predictable expenses, and because of that, they tend to give off a fairly dependable income stream. As we sit here today with the 10-year Treasury around 65 basis points, our infrastructure product has a 12-month trailing dividend yield of 2.29%. So that's 3.5 times the 10-year Treasury in yield on the product. So it's a way to get more income for those investors that are seeking income into their portfolio.
Great. And finally, what do investors need to be aware of when investing in the infrastructure asset class?
Some of the traits that investors view as desirable about infrastructure are also reasons for additional considerations. We're talking about location-specific assets that are highly regulated and are oftentimes capital intensive. So specifically, there could be excess regulation, government oversight over these assets, and unlike a common stock or a corporation that can move from one regulatory and tax location to another, that's very difficult to pull off with infrastructure assets. You can't move a power grid or a wireless network from one location to another very easily or at all. So because of that, they are highly regulated. And also you have unforeseen risks like natural disasters that can weigh on it. The way that investors needs to combat this is through diversification, diversifying infrastructure via geographies, infrastructure type, and patronage sources. So the way that we go about doing that with our infrastructure product, which is tickers NFRA, is by using a bottoms-up approach. It allows us to capture the wide swath of infrastructure assets, not just the utilities, the pipelines, the traditional transportation that you normally see, but things like cellular towers, data centers, hospital, post offices around the globe, and give investors access to all those asset classes in one fund.
Chris, thanks again for taking the time to join us. Looking forward to chatting with you again soon.
Thanks, Brenton. Thanks for having me.